And before we get into some of the connections with what's happening on the Fed side, I thought this was an interesting backdrop to show, visits to business districts based on U.S. cities with employment below 150,000 and then U.S. employment above 1.5. And you get some of the shifts in terms of, where people are, what they're doing in the world. And this is an interesting piece of why we think, things are blending. And we've been saying from the beginning that Monday to Friday travel, is going to be 10 to 15% below normal in perpetuity. And I think this does a good job of saying how we came to that number. That was just something that we were seeing in the data, but we didn't really appreciate the breakdown here, where that's kind of where you're going to settle, as you do have cities that have better that have employment. They're happier to go to the office. In larger cities that you may have to take transit, or traffic and congestion can get worse, you're seeing a more willingness to stay home. Now, the amount of occupied U.S. office space change from the previous quarter continues to fall. And again, that kind of correlates back to where things are. But this also shows the issues within the CRE, or the commercial real estate markets. And it's not going to get any better based on rates and yield and what the Fed is doing. So when we look at the Federal Reserve money supply, everyone likes to look at that top chart and say, oh, the M2 year over year change is negative 3.7%. We've never seen this without a recession. But it's like, but look at the money supply change. And we've actually seen more money go into the system recently. And that's in terms of, and we'll show the different charts on the different programs, whether it was the repo, the BTTP, in terms of some of the bank financing that was issued after SVB went belly up and you had small bank pressure. So again, even though they've held to this QT, or quantitative tightening side, when you look at interest rates going up, they've also been funneling money down and into the system in different ways. And so it's important to appreciate the two. Obviously the percent change has to come down, but also going back through the 60s, we've also never seen the percentage increase from 5% to 25%. Now we're seeing it go below zero, but it's going from 0 to negative 3.7, where we went from 4.5 positive to 26% positive, 27% positive. And then it's come down, but everyone's freaking out because we're below zero, but everyone's ignoring the fact that we were in double-digit growth profile. So it's going to take time for that liquidity to get pulled back out. But to their credit, you don't want to take it out too fast. Then you create other issues, which is why we're going to hang below in this sub-zero sector. But they're going to try to manage it. They're just like what the PBOC is doing. They're going to try to manage the deleveraging by draining the liquidity slowly and not all at once, because they've created a huge inflation cycle that was always there, and it's just been ripped off, especially when you go back over time and see that we've averaged over 5%, or between 5 and 10% throughout the period. But yet they've said that inflation was only at 2%. Again, not to shift too far. So as of July, the M2 money supply contracted by 3.7% year on year, but increased by 12.7% month on month. Trend shifts depend on time frame, as it still looks weak in year over year terms, but good in month over month terms. So again, that's why it's important to weigh those different things. But then when you look at what could drive the Fed to change policy, now this is where we disagree. We think that there's going to be very little that's going to change their mantra, because if you look, this is where it connects back to the 70s. When you look in 76 into 77, there was a view that the Fed had gotten in front of inflation, and that even though inflation was still high, it was moving in the right direction, and the leading indicators showed inflation continuing to fall. So they felt comfortable starting to cut rates. But as we all know now, they cut rates too soon, creating that second leg and a more powerful leg of inflation. That is not something that they want to get rid of, they want to try to get rid of that. Now, the disorderly weakness in financial markets, it's if they get to this level and then flatline, well, it's not very disorderly. We're back at rates that we've saw pre 2008. It's even pre-COVID. It's not like we haven't been here before. So I think the idea is if they were to continue to raise rates 50 basis points, 75 basis points, a full percent, that would create panic and seize things up. But to get to, let's call it between 5.5% and 5.75%, and then just hold the line and say, we're not going up, we're not coming down, how is that disorderly? And that's where, concerns about the labor market are very much not going to happen at this point in time, given, even when you restrike some of these things, it's going to be difficult to see the labor market soften. And then because the Fed fears inflation is falling too far, that is unlikely given the level. So it's really the disorderly weakness, but with where rates are right now, there's a lot of staying power here. The leading economic index, when you look at where things are, the average work week is decelerating, but unemployment claims got stronger, accelerating. New orders have started to slow down, but are still fairly stable. New order index is weak, but getting a bit better. Remember, in contraction, but not, as we were saying, kind of balancing out. Then when you look at building permits, okay, and staying there, but the leading credit index is important because it's weak and decelerating. Interest rate spread is stable. Now that's going to, those two, the leading credit index and the rate spread is where you're going to want to see things of how they're kind of sitting there. Average consumer expectations. But then when you look at the economic index on payrolls, strong and accelerating. Personal income, less transfers, decelerating, but still elevated. Industrial production, real manufacturing and trade sales. So there's really nothing there that says the labor market's in trouble. So again, that last 17% on why rates would get cut is unlikely because we still haven't seen it pull all the way through. And the net contributions to the leading economic indicators, as you can see, the jobless claims is when you look at the index component weighting, jobless claims are still okay. Stock prices are still okay. So all of the other pieces are showing the softness, but some of those key areas, both inflationary as well as labor, are still showing that the Fed can stay here much longer. Then when you start looking at the economists are a bit more, sanguine in terms of where U.S. growth is. And what we've been saying is that U.S. growth is not going to collapse. We do think it goes negative. It's just going to be at a 0.5% level. So survey of economists shows expectations for GDP to advance at an annualized 1.8% pace in the third quarter, nearly quadruple the 0.5% pace projected in July. And a lot of that is driven by retail sales. Retail sales have stayed stronger than expected, including yours truly. But the question is, when does that catch up? And when you look at savings, when you look at credit card rates, that's where they want to see and start to see that impact. But why is the Fed going to cut rates if this is the growth that's projected? Where's the impetus of an unruly market? And that's what I think people are assuming there's going to be a Fed pivot, and that's why they're starting to price in no landing, let alone just a soft landing, but no landing at all. But we do think that there's going to be those impacts. U.S. real rates are well above the R-star. So the U.S. real policy rates is well above the estimated long-run equilibrium real rate. So that's when you think of what is the neutral rate or the natural rate that bonds should be at. And so they're saying that realistically, the R rate is something closer to about 1.5%. For those that have known me for as long as maybe some of you have, my view is that it's closer to 2.5%. And people thought I was crazy when I said that back in 2020. I was like, but if you look at where things need to go and where they've been historically going all the way back through time, not just in the last decade or 20 years, we need to see some of this, especially to bring down some of that excess liquidity and normalize things. Now, the weakness in China is bullish for the dollar because this is where I think people are overplaying the Chinese side, where everyone's like, oh, the dollar's going to lose its flavor. And it's like, no, it's the US dollar is still the peg. It's still the FX reserve currency. It still dominates on a derivative basis, insurance basis, fixed income basis, on a trade basis. So it's still going to have that luster. And China still has to buy dollars to help offset renminbi or CNY. And as you get that weakness, because you're starting to see people play a carry trade if they can. It's obviously much harder in China than in other places, but that's where you're going to see this. And as I've said from the beginning, the dollar demise is continuously overstated. So here, when we look at bond volatility, it's kind of holding in at this level. And that's where you're going to want to see some of these things hold in, why they want to keep things. It's going to be more volatile. It's inherently going to be the case. But monetary policy has a 15-month lag. And so if you start to offset it now, well, you might get a little bit of a benefit, but then you're already seeing home prices start to peak back up. You're starting to see prices on the service side, in the manufacturing side, which we'll show more in the next segment, accelerating again. So it's like you're actually seeing inflation ramp back up. And again, you still need to let all of this come through in order to impact and have the impacts you were hoping for. Corporate interest payments are about to rise, but they're still not at a point of pain, pain pressure. It's like the interest payments that they have at this point are not something that's going to drive them into bankruptcy. It may drive some of the zombie companies into bankruptcy, which we want. We need to clear the deck. But it's interesting because most soft landing stories since 2008. So when you look at that count and how people are searching for it, typically that dies away as it has started to, as the story count on recession has gone away, story count on soft landing has gone away, and typically you kind of get that snapback. Now, when you look at the liquidity, we've talked about the Bank Term Funding Program, the BTFP, and when you look at the BTFP, as well as the Fed discount window, you get an idea that there's a lot of liquidity out there, and you don't want to see that bank term funding program going higher, but we are, because small banks are still struggling. And that's why we see the Fed continuing to maintain these products. But again, that's also going to balance where what you can still maintain higher rates, especially if you see some of the interest expense sitting where they are. Level of Fed balance sheet continues to fall to the lowest since mid-2021, but it's accelerating. But look at the blue line. Yeah, it's starting to come down, but then you got a little bit of a bump, and we still are supposed to be much lower. I mean, Bernanke said we were going to be below 1 trillion by the end of his stay, and right now we're at 8.146 trillion. So you get an idea of there's still a lot to come out. And here's where we look at the voting members, where growing differences among FOMC members as to where monetary policy goes shows the difference in influence. So I think it's funny that Neil Kashkari is actually pushed closer to a hawk, because that is fascinating. I would put him very much at the bottom with the doves. But I guess because he's been more realistic that we need to keep things a bit tighter. And I think at this point, especially if we get the acceleration in inflation that we're expecting in August, I think it's going to have them rethink some of their stance on where rates can go. Powell has left the market open to have another increase, and I think it's likely that we do get that one more quarter point. I don't think we get another after that. But here's kind of giving you that visual of where we sit. Now, the lagged effects of the Fed hikes will continue to drag down growth, but the drag on growth is going to accelerate, and then it starts to mitigate. And that's why you don't want to over tighten, which is something that Volcker came out and said, is that he wished he stopped at 18-19% and not all the way to 21%. But at the same time, he had to regain a credibility, if you will. And the last thing that the Fed wants to give up is their credibility, which has already taken a hit. So getting to a point and then holding firm is going to be a really good situation, which can mitigate some of the GDP growth anchors while not impacting it to a huge degree in general once you slowly take that liquidity out, instead of ramping it up and then cutting it back down and creating more volatility. Now, the U.S. government shutdown is always fun when we get to that point. We do have to release or borrow another. I think they increase it to 1.75 trillion. So it just gives you an idea that we're coming up on that point, especially as tax income has slowed. So here, when we start looking at high yield versus treasuries, you get an idea of that there's still this level of disconnect. So realistically, we do see high yield spreads going out further. It's just going to be a matter of, how long does that take? And then that will, again, cool off the bond market a bit more. Private credit loans reached a recent high. And it's interesting because when you look at some of the levels, it's like, well, people are willing, because they have the money at this point and they have it on the sidelines. It's like, well, why don't I just do the debt, do the loan, instead of going through a bank or going through something else? So that's another way that we've also seen some private credit loans get structured. And we're seeing more of that, and banks willing to do that with some of their high net worth clients. So here, when we start looking at, again, the money kind of sitting on the sidelines that could go into these private numbers, USD money market funds are over 5.5 trillion. And then on the retail side at over 2 trillion, which is a concern because, again, the money market funds is also corporations that might just keep that working capital. And that, instead of putting it into CDs or something else, they keep it as in Fed at the money market rates. But it puts pressure on overnight risk at overnight rates because, who are you going to give it to? Where is it going to go through? And that, again, could be a bigger issue. Then when we start looking at import pricing, when you start looking at some of the different shifts, here's some of that reacceleration on inflation. So it's still negligible, and we haven't talked about it too much because it was a bit volatile, but it was, we were importing deflation just given where prices have gone. But that benefit is starting to mitigate. And that's an interesting thing. We don't think it goes positive, but the benefits to our deflation story are starting to be offset. You're also starting to see core service PCE ex housing starting to track a bit higher. Core service CPI flatlining. These are the problems that we see where there's a growing potential that core PCE inflation could actually run above core CPI, reversing the historical gap, and we continue to look for the Fed to keep rates on hold into the second half of 24. And that's a likely situation because they're looking at PC. They were expecting a meaningful drop, and we're starting to see that support and acceleration. Global yields hit a 15-year high. Debt sell-off extends despite the hopes that central banks will pivot. And it's because it takes time. You need to see, you've had this extensive cut. Now you need to see that come out with investors, but investors are positioning saying like, look, yields are going to fall. We don't believe they fall. We believe they pause. And some of that shorting is going to help kind of create that backdrop where we're not going to get too much higher, but we're not going to come down too much as you get some of that balancing act through the remainder. Riskier corporates succeed in pushing out that maturity wall. So again, you've seen some of that push where they've been able to refinance, and that extended some of the gap, which also gives the Fed some breathing room. They don't have to worry about some of these corporations. They'll be able to manage it, but the credit spreads disconnect from the real economy still remain the case. And as we were saying before, bankruptcies are still up, again, kind of clearing that deck. You don't want a huge surge, but you do want some natural movement. But the high yield spreads have not really matched that in general. And here's look at the HELOCs. So home equity lines of credit, or HELOCs, ended last quarter 340 billion, marked the fifth consecutive period of growth. Overall quantity of loans declined by 70,000. So essentially, there's less loans, but higher rates or higher amounts. And then you look at the national average CD rate, and the 1-year CD rate went up again, which is also increasing the cost of banks to keep some of this cash that they can then go out and manage. So it's just a matter of this balancing piece. Now, we don't see HELOCs going back up because the cost of them is increasing. So you're starting to see some of that balancing. Short-term equity sentiment has gotten way too negative, which is why we did see the bounce yesterday. We do see some strength in the equity market in the near term, and we are seeing less support for single stocks and more support for ETFs in general. Now, it's interesting because here's a key point when we start looking at household excess savings. And this one shows, as we showed last week, that the savings has actually been completely exhausted, which we do think is likely. If not, if there's still maybe 200 to 300 billion left, a lot of that is locked at the higher income level, and we won't see that move through. Now, truck tonnage has also slowed down a bit, which is going to create some additional pressure in general. When you look at, we did see an increase. We saw that kind of come through. We do see a decline, but we do see a bit more of a bump higher as we go into the fall. And that's just, again, creating some more opportunity and some additional flows given what is going to come into the system for the holiday season. U.S. delinquency rates on consumer credit cards has increased, and that's likely going to get worse as student debt balances by age group goes back up. As the moratorium ends, we do expect to see a bit more pressure. And as we've talked about, that credit card rates delinquency is going to be a much bigger issue when we start looking at how that impacts banking, especially the small bank pace. U.S. The wave of small business hiring is slowing. That's really what the Fed wants to see. We're still well below the natural rate. That's going to put a bit of a pressure point here. And that's what we've talked about recently as we've started to see some sales slow a bit at the small businesses. And that's going to put a little bit of a headwind. U.S. Business Confidence Index, again, still negative. U.S. prices charged accelerating. Again, this is kind of that backdrop for stagflation that we've talked about, where business confidence isn't really there, but they're still increasing prices because they have to try to maintain their margin, and wages are still going up. Then when you round it out, before we get into the next segment, the number of consecutive months of monthly leading economic indicators decline reached its 16th consecutive contraction. The streak that long has only been seen in recessions that started in 1973 and 2007. And it kind of gives you an idea of how low that's gone, how we haven't had this extreme drop, but again, it's still putting a lot of weight on where we are at the moment. So that's what we have for you in segment 2. Next segment, we're going to go deeper into what's happening with some of the leading indicators and some of the pressure we see on that front.